All right, let's jump right in. Today, we are going to tackle something that holds a lot of people back from building wealth. We're talking about how to invest your money when you're not an expert. And the answer, mutual funds, is something we're going to make so simple you could literally get started today.
You've probably thought about this a lot, right? You want to grow your money, you hear everyone talking about investing, but the stock market just feels so complicated and risky. It feels like a club for experts only.
I mean, you could just try to buy individual stocks, but think about what that really means. You'd have to do tons of research, you'd be putting all your eggs in just a few baskets, and you'd have to watch the market constantly. Honestly, who has time for that? It's like a whole second job.
And that feeling, right there, that is the classic investor's dilemma. You want the amazing growth you can get from stocks, but you just don't have the time or maybe the desire to become a full-blown financial analyst.
Well, I've got some good news. You are definitely not alone in feeling that way. And even better, there is a tool that was specifically designed to solve this exact problem. It's a way to get in on the action without needing to be a Wall Street whiz kid.
And that solution, the one we're diving into today, is the mutual fund. It is hands down one of the most popular ways for regular people to start investing, and there's a really, really good reason for that. So what on earth is a mutual fund? Think of it like this. It's basically a company whose whole job is to take money from a bunch of different people like you and me, pull it all together into one giant pot, and then go invest that big pot of money for everybody. It's like teamwork for your money.
So how does that actually work? It's a pretty simple three-step deal. First, you and thousands of others chip in your money. Step 2, a professional fund manager, someone who does this for a living, takes that big pool and invests it across, say, 50 or 100 different stocks or other assets. And then step 3, you own a small piece of that entire collection. That piece is called a unit. So right away, you're diversified without having to buy all those stocks one by one.
Now, the price for one of those units has a special name, the net asset value, or NAV. The easiest way to think about it is that it's just like a stock price. If a fund's NAV is, let's say, 20 rupees, and you invest 100 rupees, you'll get 5 units. It's that simple. And as the fund's investments do well, the NAV goes up.
Okay, you get what they are. So, how do you pick one? Because they're not all the same. Different funds are built for different goals. So let's break down the main types you'll see.
It really boils down to 3 main categories based on your goal. Are you looking for big growth over many years and you're okay with some ups and downs? Then you're looking at equity funds. Or do you need more stability, maybe for a goal that's just a few years away? That's where debt funds come in. And if you're thinking, I kind of want a bit of both, well, that's exactly what hybrid funds are for, a mix of growth and safety.
Now, I want to give a special shout out to 2 super popular types. First, index funds. These are amazing for beginners because they don't have a manager trying to pick winning stocks. They just automatically track a big market index, like the Sensex. They just are the market. Then there's something called ELSS. These are equity funds with a really nice perk. They can help you save on your taxes. The only catch is you have to commit to keeping your money in for at least 3 years.
So when you're actually looking at a specific fund, here's a quick mental checklist. First, look at its past performance. How has it done over the last 1, 3, and 5 years? Next, and this is a big one, check the expense ratio. That's the fee. Lower is always, always better. Also look at the fund size, or AUM. A big fund size usually means it's pretty stable. And finally, it's worth a quick search to see who the fund manager is and what their reputation is like.
Okay, let's talk about 2 things that are absolutely critical to understand because they directly affect how much money you end up with. We're talking about costs and taxes.
So first up, every single mutual fund comes in 2 versions, a regular plan and a direct plan. A regular plan means you're buying it through a middleman, like a broker, who gets a small commission. A direct plan means you're buying it straight from the fund company online, cutting out that middleman. The takeaway here is huge. Direct plans have lower fees, which means more of your money is actually working for you. So always, always look for the direct plan.
So what is that fee, the expense ratio? It's just a tiny percentage that the fund company takes each year to cover their costs. Imagine you invest 100 rupees. If the expense ratio is 0.5%, then 99.5 rupees gets invested for you and 50 paise goes to the fund company. It sounds like nothing, right? But believe me, over 20 or 30 years, that tiny difference can add up to thousands of rupees in your pocket.
All right, now for taxes. For equity and hybrid funds, it all comes down to one simple thing. How long did you hold your investment? If you sell within 1 year, your profit is considered a short-term gain and you'll get taxed at 15%. But if you just hold on for more than 1 year, it becomes a long-term gain. The tax rate drops to 10%, and on top of that, the first 1 lakh rupees of profit you make each year is completely tax-free.
This is a massive reason to think long-term.
For debt funds, the rule is actually a bit simpler. Any profit you make from them just gets added to your total income for the year, and it's taxed at whatever your personal income tax rate is. Easy peasy.
Okay, we've covered the what, the why, and the nitty-gritty details. Now for the most important part, the actual practical steps to get you from zero to investor.
And I promise you, it is this simple. First, you pick an investment app you like. Second, you do a quick one-time ID verification called KYC. Third, you link your bank account. You can do all of this right from your phone, usually in just a few minutes. And then, step 4, you pick your fund and you hit invest. That's it. You're officially an investor.
Now, when you do go to invest, you'll see two main choices. You can do a SIP, which stands for Systematic Investment Plan. That's where you invest a small, fixed amount every month automatically. It's fantastic for building a habit. Or you can invest a lump sum, which is just a bigger, one-time investment. That's perfect if you've got a bonus from work or some savings just sitting around.
So to wrap this all up, I want to leave you with one key piece of wisdom that comes straight from our source material. The real magic of mutual funds, especially the equity ones, happens over time. This isn't about getting rich quick. The advice is to think in terms of at least 5 to 7 years. Whatever you do, try not to sell in that first year.
So there you have it. We've pulled back the curtain on mutual funds, from what they are to how you can buy one literally today. The knowledge is all yours now. The only question left is, what's your first step going to be? Thanks for tuning into this explainer.